In the previous lessons, we've been talking about credit cards. In this lesson, we're going to talk about loans in more general terms. So credit cards are used for borrowing small amounts of money to make small purchases, but loans are a way of borrowing large amounts of money. So here are some different types of loans that you might come in contact with. We already talked about credit cards for small loans. You can also have something called a line of credit or a student loan, OSAP if you're going to college or university, a mortgage for if you're buying property, a cash advance, or a payday loan. So I'm actually going to get you to do some research about payday loans in the practice part of this lesson. Here are some things to consider when looking at a loan. The interest rate, the term, the regular payment, whether the loan is secured versus unsecured, and if there's any penalties or fees. So the interest rate questions you should ask are, what percentage of the loan amount do you need to pay back every year? This is the cost of borrowing the money. The term, how long will you take to pay back the loan? Some loans require you to pay off the loan over a certain amount of time. You'll see this in a car loan or a mortgage. For regular payment, how often will you pay? How much will you pay each time? So are you going to pay a certain amount each month or each week or every 2 weeks? That's the regular payment. A secured loan means that you are putting up something you own as collateral, which means if you don't pay off the loan, the lender will then own whatever you used as collateral. For example, if you purchase a house using a mortgage, the house is used as collateral. If you can't pay your mortgage, the bank owns the house. Penalties or fees. Some loans have extra fees that you must pay in addition to the interest. There may also be penalties to pay if you make a late payment or if you pay off the loan early. Yes, if you pay the loan early, you might have to pay an extra fee. These are all things that you need to consider when you're getting a loan. Now, sometimes loan calculations are a little more complicated than compound interest calculations that we've been doing in this class because of that regular payment. It makes the calculation more complicated. So you can find online loan calculators. I found one here. There's the address. You can type that in, or you can just in Google type loan calculator. And when I did it, this was the first hit. When you get here, you'll see this, and this is the actual loan calculator. If you find a different loan calculator, it will probably be set up very much the same as this. You'll type in the loan amount, so how much are you borrowing? The loan term, so how many years, how many months is it? What's the interest rate? How often is it compounded? And how often are you paying it back? So are you paying monthly payments, weekly payments, bi-weekly payments? You would select it there. Then you would just click calculate, and it will tell you things like how much your regular payment will be and how many payments will you make. What are you going to end up paying? How much interest will you end up paying? These are all things that you can calculate using an online loan calculator. So let's work through some examples. You have borrowed $5,000 at an annual interest rate of 9.5% compounded monthly. You will pay it back every month over a 2-year term. So if you go onto your online loan calculator, like the one I showed you, this is what you would type in. The loan amount is $5,000 because that's how much you borrowed. The loan term is 2 years because it's a 2-year term. Interest rate, 9.5%. That's where I got it in the question. It's compounded every month, compounded monthly, and we're going to pay back every month. Pay it back every month. So once I've filled it in, I click calculate, and this is what shows up. At least on this loan calculator, this is how it displays the results. So now we can answer these questions. What is the monthly loan payment? Well, here it is. Payment every month, $229.57. How much in total do you end up paying over the 2 years? Total of 24 payments, $5,509.74. How much interest did you end up paying? Total interest, $509.74. So these are the types of questions you can answer using an online loan calculator. You can also play around with the numbers in the loan calculator. You can change the term of the loan to be 1 year instead of 2 and see how that changes the monthly payment. If you decrease the amount of time, your monthly payment is going to be higher. You can also see what happens when you change the interest rate. If you increase the interest rate, your monthly payments are going to go up. If you decrease the interest rate, your monthly payments are going to go down a little bit. And you can also see what happens when you change how often you're making your payments. And you'll see the more often you're making your payments, the less you end up paying for the loan. So if you ever do get a loan in the future, try to pay it off as frequently as possible and as fast as possible. That way you can decrease the amount of interest that you end up paying. So you might not be able to control how long your payment is repaid. So for a car loan, they might require you to pay it back over a span of 5 years. You might not be able to control the interest rate, but one factor that you can control is the amount of your payment. If you can afford it, you can pay more than the minimum repayment amount for the loan. This will help you by reducing the amount of interest you pay. It will also reduce the term of the loan. So if you ever get a mortgage to purchase a house, pay it off as fast as you can with the highest payment that you can afford. And that way you don't end up paying thousands and thousands of dollars in extra interest.